Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. So I'm sure you're ready for today's Going Long podcast. I'm your host, Billy Keels, and I am super excited to bring you backstage a little bit. This isn't a place you normally see, but listen, today's guest has made such an amazing impact in this conversation that we've made a decision to do something really important for you so that you get the most out of this conversation. We've decided to make this into 2 episodes. So today you're going to get the first part of the conversation with one of my mentors, as well as financial strategist and co-host of the Real Estate Guys, Russell Gray. And then you're going to get to check out the second part of the conversation very shortly. But I just want to highlight a couple things and then we'll get right into the conversation. So today you are going to find out really about the background of Russell Gray, being the son of immigrants, also finding out where Russell is. He gets very vulnerable in the first couple minutes of the conversation, helping us to understand where he is today in his life. Then we get into the conversation. You're going to find out some really amazing things, understanding more about what our financial system is built on. He's going to talk about how taxes and wanting to understand more about that affected his worldview and is now helping you as he goes out to educate you. We talked about the reason that 20,000 tons of gold that the U.S. had really was one of the reasons that put the U.S. in the driver's seat from a global financial perspective. We're going to play some numbers games. I think you'll really like this numbers game. We're also going to get into some of the different relationships between bonds, bond yields, and prices, and how that is important. We're going to talk about inflation as well. We're going to wrap up with kind of a very interesting question on the first part of this conversation. So I don't want to really stop anything else. I want us to jump right into the conversation. You are going to get so much out of these 2 parts of this conversation with Russell Gray. I want you to go ahead and get started, and let's enjoy the conversation. Welcome to the Going Long podcast. We're back once again to continue to help to educate you so that you feel comfortable as well as confident investing beyond your backyard. I'm your host, Billy Keels. And if you've ever needed help in navigating uncharted territory so that you can protect and grow your wealth investing in real assets, then today is absolutely the conversation that you're going to want to listen to until the very end. Because today's guest is not only the father of 6, he is an avid student of economics with a diverse background in business, investing, mortgages, and financial services. He also has very unique insights to help entrepreneurial investors to grow and protect their wealth through real estate and real asset investing. He's also the financial strategist and the co-host of the Real Estate Guys. Welcome to today's show, Mr. Russell Gray. Russ, welcome to the show.
Hey, Billy, thanks for having me.
I am really looking forward to today's conversation. I know there's going to be so much value added, and let's get right into it. So listen, Russ, we have kind of 5 questions we always ask everybody. Everything else is just a great conversation. So it helps to give us a little bit of structure. The first thing is, where are you located in the United States?
So I'm in Arizona. I like the heat. I like the sun. And I had a situation where my wife got ill and we ended up here for her treatment. And I just kind of liked it. So here I am.
All right. Fantastic. Arizona. So the great Southwest. And Russ, what is the most positive thing that's happened to you in the last 24 hours?
Well, every day is kind of an adventure, for me after 43 years of marriage, trying to figure out who I am without my wife. So that I get little breakthroughs from time to time. We were talking before we went on mic about that. But if I can go outside 24 hours, just a little bit,
right,
my nephew played in his first professional football game on Sunday. And they were underdogs, and he caught a critical pass, his only catch of the game on 3rd and 8, converted to a first down, put him in field goal range. They made the field goal to tie the game. They went on to win the game. And then when they took the victory formation to run out the clock at the end, he was the safety behind the quarterback. And when they kneeled down and the clock ran out, he threw a standing backflip on the field on national television. And I just thought that was the coolest thing.
Wow. That's awesome. Awesome. So thank you for sharing that with us. And listen, Russ, I've given a couple of highlights about who you are, but it would be great if you could give us a little bit more about your backstory, please.
Well, I'm old, so it's a long story, but I'll try to keep it super brief. I'm the son of a Filipino immigrant. His father was a freedom fighter and occupied the Philippines when the Japanese, which was a horrific occupying force. I mean, I could tell you horror stories. And so I kind of come by this love of liberty and freedom. It's in my DNA. My dad became an entrepreneur in Silicon Valley and started a high-tech company. And so I saw that and I understood the value of equity. When I was 18 years old, I moved to Southern California and got mentored in outside sales. I opted not to go to college. I bought my first property and started a business. By the time I was 20 years old, I'd made more money in equity on both the property and the business than I'd made in both my wife and I working full time. So I discovered the power of mentorship, the power of real estate, the power of equity, power of entrepreneurship. So I discovered a lot of things early in life. I went into outside sales, corporate sales in Silicon Valley, did that for a number of years while we were having children. Then I found out life was a lot more than making money. I started paying a lot of income tax and in trying to figure out how to mitigate that tax, and homeschooling our children, and I was responsible for history. I started unpacking the economic history of the United States. And that was really a revelation for me. And I came across the writings of Irwin Schiff. And since then, I've become friends with his son, Peter. I didn't know they were related when I met Peter, but it was really eye-opening. And Irwin was a tax protester, but his basis for protesting was in the law. And he felt like the law was not valid. And there was a whole group of people, there still are, that believe that. And that kind of opened my eyes up to what people, I guess, would call the matrix, that there's a lot more going on behind the scenes than you really understand. And so I started really studying history. I came across a book called Creature from Jekyll Island in 1995, just a year after it had been released. And that kind of like put in the missing piece of the puzzle. And I understood that our financial system was all built on debt, and that debt was really a system of slavery. Was a modern system of slavery. So kind of like a, wannabe Moses. I was like, I wanted to set the people free. And I said, well, I want to get into financial education. And so from 1995 to 2000, I wrote a business plan for a financial mentoring program and decided to enter the financial business again. I had previously been in it. Took a little time out in an entrepreneurial venture and went into the insurance business. I took a break from my corporate life and then failed in my insurance business, went back to my corporate life. But my next foray into financial was not based on making money. It was based on mission. And so I started a mortgage company and decided I was going to market it through education. And I started going to seminars to see how people were doing it. And that's where I met a guy named Robert Helms. And Robert and I started collaborating and doing some joint venture marketing, him in the real estate business, me in the mortgage business, together in the education business. And it just worked. We ended up building a big mentoring program in Silicon Valley. We became really influential in several markets. Phoenix was one of them. Las Vegas was one of them. We were the first people outside of the insiders at MGM to see the plans and know the plans for what became City Center, biggest real estate development, I think, at the time in the world. And we were instrumental in helping the listing agent get that listing, which was a career maker for her. So just a ton of fun. TV show, book, all that. Then everything blew up, as you know, in 2008, and the world changed. And so then the last 10 years have been about really understanding how a guy like me could have missed all of that and been so badly hurt, so badly blindsided, have my portfolio and my businesses so wrong-footed and unable to respond quickly enough to prevent being wiped out. And so the rebuild has been a lot more systematic, methodical, patient, mature. And, here we are in 2020 facing, again, the potential for maybe the greatest financial crisis of my lifetime. And I've been around for a while. And I feel, you never feel completely prepared, but I feel like I have a better idea and I'm better positioned than I've ever been before. And I'm not really as afraid now as I am curious, and resolute in trying to experience it and help as many people as I can, be as prepared as they can, even though we can't predict everything that's going to happen. So long answer, but that's kind of the nickel tour of the last 60 years.
Well, and that's great, because at the end of the day, it's like you said, you're really focused on how you can continue to go out, educate, and help other people so that they are more prepared. And I mean, you talk all the way from son of immigrants and having had a focus early on really more on the sales or the money aspect, and then it's become really focused on mission. And so as you go through that, you've thrown out a couple of things, and I know that you've had a really awesome sales training, and you also really help people in sales training today and getting educated on the best profession in the world, in my opinion. So I want to play with a couple numbers, if you don't mind. And so Sure. You've kind of talked about some of them already, but I'm just going to throw out a couple of numbers. And if you could, starting with the first number and ending with the last, it's really to help people understand how important these numbers are from a historical perspective, and really how it's affecting us today in 2020. So just be patient with me just a second. So the first number is 1913. The second number is 1944. The third number is 1971. And then the fourth number is 2008, which is the fifth number, 2020. So I know that you're really familiar with those, but help
Sure.
those so we understand how these numbers affect us today.
Sure. Well, 1913 was the passing of the 16th Amendment, the formation of the Federal Reserve, the introduction of the income tax, and the beginning of the banking takeover of the world, the cartel. And 1944 was the establishment of Bretton Woods in the wake of World War II. The United States had 20,000 tons of gold, the largest army, the most fearsome arsenal with the atomic bomb. Nobody dared stand against them. And so we implemented a basic takeover of the world's financial system and used the dollar to replace gold as the world's reserve currency. In 1971, Nixon broke Bretton Woods and defaulted on that, and people could no longer redeem their dollars. And that ushered in an era of out of control debt, out of control inflation, and they reset the interest rates. This is a date you left off, but they reset the interest rates in the early 80s under Paul Volcker, so that we could have a continual expansion of the bond market, which is debt based on ever decreasing interest rates. Well, we hit the zero bound, and coming out of 2008, but 2008 was really where there were things going on in the financial system that people weren't aware of, and that was that the requirement to create debt was so severe that they were creating things called derivatives, debt not backed by anything. And I could go into a whole dissertation on what that is. I spent years studying it because I was in the mortgage business, and that was the bomb, the nuclear bomb, financial bomb that went off, and I happened to be right in the epicenter when it happened. And it was, with no warning. I mean, the warnings were there, but I didn't know how to recognize them. And of course, 2020, now we are in a situation where everything that was wrong in 2008 is still wrong on a bigger level, except that their ability to react to it and understand it, and not be in shock, but to really get in front of it, drop interest rates right away, print money right away, fiscal stimulus, which is government spending, combined with monetary stimulus, which is Federal Reserve making money available, all of those forces to bear, putting really all of the pressure for this entire economic crisis in 2020 on the US dollar. And the biggest concern I think that investors should have, that most don't right now, is that it could break the dollar. And if the dollar breaks, especially for Americans, the world becomes very, very, very different. And you can see the central banks in 2019 moving into gold. You can see now Main Street moving into gold. There's a reason for that, and people are afraid. And maybe there's a role for crypto in that. I think there's a generation of people that think crypto is like digital gold. I think they're very different. They both have roles to play, but for different reasons. But I don't think they're one and the same. I don't have a problem with people doing both. But if I could only pick one, it would be gold.
Okay, fantastic. So it would be gold. And thanks for adding the extra date, and thanks for tying that all together and helping us to understand where we
Well,
are
I mean,
today.
Billy, if you really want to understand those dates, you go back to 1865, because that's when Abraham Lincoln instituted the first income tax. And then 1907 was the financial crisis. That was the crisis they used to justify the formation of the Federal Reserve. And then, of course, the 1920s, the Roaring Twenties, was the result of being able to print unlimited amounts of money because of the Federal Reserve and not knowing how to manage this power tool. And whether they crashed the economy on purpose or by accident, I don't know. It doesn't really matter. It happened. It was, so there's some history there that I think anybody that's really a student of economic history should study that as well.
Fantastic. Well, thanks for adding those extra dates. And guess what? I have a couple extra dates to go back and revise as well. Russ, you mentioned something as well. You talked about gold, and I just would love for you to clarify that, because when you talk about having gold, do you mean those like gold ETFs, or are you talking about actual gold that you hold in your hand?
Well, I mean, if you're chasing the price action, you can probably get away with the ETFs, but that, what you're doing there is you're using a proxy, if you will, a chip. Just like when you go to a casino, you take your money and then you buy a chip, and the chip is a proxy for the money. And you go in the casino and you play. And then if it works out well, then you go in and you return the proxy for money, or in this case, currency, dollars. So a lot of people use stocks, bonds, Bitcoin, precious metals as houses, as vehicles to churn, to flip, to speculate with, to gamble. In some cases, you can add some real value. But at the end of the day, the trip goes like this. I'm going to go from cash. I'm going to purchase whatever it is I'm going to purchase. I'm going to hope to sell it later, buy low, sell high. And I'm going to finish the round trip with dollars. Well, if you listen to what I just talked about, that all the pressure's on the dollar. If the dollar fails, right, there's nobody in Venezuela that wants bolivars. They're worthless. Nobody in Zimbabwe wants Zimbabwe dollars. They're worthless, right? If the dollar goes the way of these other failed currencies, you're not going to want dollars. You're going to want things that are real. And proxies for things that you can trade in to get dollars aren't going to get you home. So I think that anybody that really wants to have something that is real, that, JP Morgan said, gold is money, or money is gold and nothing else. In other words, if you understand that precious metals for thousands of years of human history has been money, and there's a reason for that. You may not understand the reason, but just until you do understand it, just accept it, that's the way it is. Or if you can't refute it, then at least default to it. But you're going to want to have some real physical precious metals in your possession, because there's no counterparty risk. And nobody's promising, like money in the bank is a promise the bank has. An insurance policy is a promise the insurance company has. Even stock in your portfolio is a promise that your broker has, right, to you. And if they break those promises, you don't have anything. If I have gold in my safe, nobody has to keep a promise. It's there. I own it. There's no counterparty risk. There's no claim on it. It's free and clear money. It belongs to me, and I can pivot into any currency I want.
Which is fantastic. Thanks for helping us to understand that, and then understanding. I think there's this misnomer sometimes when you think about gold, or you think about bullion, that it takes too long to actually liquidate it, or what would you do with it if it were just in your home? So the whole counterparty risk is it helps you to have more security, and it is, contrary to what many people think, it is highly liquid, right?
Very liquid. I mean, central banks bought more gold than ever in 2019 since 1971, when the dollar collapsed, when Nixon defaulted on Bretton Woods. That's a clue, right? When you come to currency, if you look at insider trading, who's more of an insider than central banks? And if central banks are stocking up on gold, what does that tell you about their confidence in currencies? They could be stocking up on dollars. China's dumping dollars right now. Russia already completely dumped them. Right. Even Japanese, the Japanese government has been stocking up a little bit, but the Japanese people have been divesting. So, you just have to understand, there's a whole lot of economic history a lot of people are unaware of. Most investors are pretty myopic, and they pivot off of mainstream headlines. But I can tell you, being in financial media, alternative financial media, but interacting and watching a lot of conventional financial media, most financial media, mainstream financial media, really exists to protect and promote Wall Street. And that's why you don't hear them talk about real estate investing. You don't really hear them talk much about gold, really. They have to sometimes. They'll talk about Bitcoin sometimes because they have to, but they don't want to. They want to talk about stocks and bonds and mutual funds and maybe treasuries. That they all are playing in a casino. And if you want to use things that aren't part of their casino, they don't want to talk about it. So you have to be very careful where you get your information.
Yeah. So being careful where you get your information is really important. Also finding sources of Robert Kiyosaki says, there are three sides to every coin, right? And so being able to stand on the edge and being able to see that and make up your mind is really important. Now, you also mentioned something, Russ, and I guess because there are so many high paid professionals, right, that are extremely busy. You mentioned something earlier. You're talking about the market and the chips, but two concepts maybe that I'd love for you to talk to us about. So when we talk about the market, right, because I'm in conversations constantly, you say that, well, the market is going really so well. The market's going so well. And there's this misnomer that that's also a reflection of the economy. And so what are your thoughts on that?
Well, I mean, so there's the financial system and then there's the economy, and those are two different things. And the stock market is a gauge. It's not really a great gauge. The reason they want you to pay attention to it is because it's a very easily manipulated gauge, especially the Dow Jones, right? There's a lot of attention on the Dow Jones, 30 stocks. And if a stock starts not doing what it's supposed to be doing, they switch it out. They just did that. Yeah. And so it's just like the CPI, the Consumer Price Index. If that's not behaving properly, they change it, right? So, I look at it like this. If you think that the gauges are the answer, and you can find a way to manipulate the gauges, you can create a false premise. So let's just say, for example, that you realize that a healthy human being, a healthy body temperature is 98.6, and you come across a dead person and they're cold. And so you say, well, we need to get them up to 98.6. And so you stick them in an oven and you heat them up to 98.6. So your gauge says, oh, this person's healthy. They're not healthy, right? So you hear a lot about zombie businesses and zombie economies and stuff. So it's just important to understand. So the financial system is debt. It's the currency, it's the banking system, it's the bond market. That's the financial system. I'm guessing most people listening to this, because this is how I was for the longest time, don't have any idea how to read the gauges that tell you what the strength of your financial system is. So imagine that you're going down the road to riches in your vehicle, whatever your vehicle is, and you're looking at the speedometer, how fast you're going, and you're looking at the odometer, how far you've traveled and how far you have to go, and you feel like, hey, I'm making pretty good progress. My 401k is up. I'm putting away 20% of my income. I'm doing really, really well. My numbers look good. Okay. What you don't look at is your oil gauge or your engine temperature gauge, and you don't realize that the financial system, the vehicle that you're operating in, is failing. It's broken. And then that's when a 2008 comes along and just wipes everything out. Well, how does it wipe everything out? Asset prices are based on the volume of currency floating around in the system. And so through comparative sampling, which is how most appraisals are done and how stocks are valued, if Apple has 100 million shares of outstanding stock and somebody comes along and sells 1,000 shares, which is a molecule in that ocean of stock, and sells it for a price, then everybody who holds all the rest of that stock on their balance sheets assumes that their stock is worth the price of the last sale. I mean, that's what that little ticker going across means. But that's not what it means at all, because if everybody went to go sell, it doesn't mean that at all. It's no different than the way I teach it is if you had an economy with $1 million in it and you had 10 houses in it, all exactly the same, if you just divided out the available money in the economy, $1 million, by all the available capital or assets in the economy, each one would be worth about $100,000. But because they don't all sell at the same time, and there's $1 million available, somebody in the economy could say, hey, I've got $200,000 and I'll pay $200,000 to get one of those houses because I really want that one. All right. Now, those other 9 people that own those houses all think their house is now worth $200,000. Well, 10 times $200,000 is $2 million, but is there that much money in the economy? No. Well, how do you create that? I'm going to go into the future and get future money and bring it into the present. That's called a loan. Everything that gets financed goes up in price. That's why the government completely shoots himself in the foot when they try to make things more affordable. Look what they did to college education. We're going to help make college education affordable. How? By guaranteeing student loans, by making student loans more available. What happened to the price of college? It went up because you added leverage. Okay, so now if adding leverage makes prices go up, what happens when credit markets fall apart? Prices fall. That's what happened in 2008. Okay. So if you're cruising down your vehicle on the road to riches and you're just looking at asset prices that are based on comparative sampling, 5 stocks out of 30 that are making the difference, Facebook, Amazon, Netflix, Google, Apple, you look at that and somebody can go buy a handful of those stocks and move those indexes to give you a sense of false security. And you're not paying attention to the credit markets. Like if you didn't know that the repo market, the Fed was pumping hundreds of billions of dollars into the repo market last September, way before COVID, and you maybe saw that in the headline and said, I don't even know what that means. But that was a sign that something was wrong. And of course, 10 years ago, I wouldn't have recognized that sign. Today I did because I spent 10 years studying it, because I recognized that there's a whole lot of smoke and mirrors out there and you better learn to read the gauges. So it's a big answer, but I don't know that I fully answered, but there you go.
Well, you did. You definitely did, because you're helping us understand the difference between the financial market and the economy, right? And so and you've also led us into one other thing. And a lot of times people, when they're scared, they want to go to bonds or they want to go to dollars, right? And so I'm just. You started talking about it a little bit, and I'd love for you to give a bit more explanation, right? And so when you talk about thinking about the bonds and dollars, and they're not really the same safe havens that they used to be. And I know you talk a lot about what is happening with real interest rates, and then how that happens, what effect that can have on bond prices, and maybe why people aren't running there.
Yeah, well, I think the first thing, the most important financial concept I think people have to understand the system and the motivation behind the people that have their hands on the levers, is that bond prices, the value of a bond, is inversely correlated to its yield, to current yields. So that sounds complicated. Now, if your listeners are accustomed to real estate, they understand cap rates. People who invest in real estate understand cap rates, that when cap rates are going up, it's either because income is going up or it's because prices are falling. So the ratio between the yield on it and the price are inversely correlated. And so I look at it this way. If I buy anything that's throwing off $5,000 a year of cash flow, if I pay $100,000 for it, then I'm getting a 5% yield on my capital. If I pay $50,000 for it, I'm getting a 10% yield on my capital. So if I bought something in a 5% environment and paid $100,000 to purchase that $5,000, and now the going rate in the market, the expectation of bidders is 10%, I'm not going to get a $100,000 bid on that $5,000 stream of income. I'm only going to get a $50,000 bid. That's a 50% reduction in the principal value of that holding. Okay, now that's what a bond is. So imagine that you've got a bunch of bonds out there that were issued in a 1% environment and interest rates go up to 2%. What happens to the value of those bonds? They fall. And so that's one level of problem. The second level of problem is people who have these bonds on their balance sheet, big, major financial institutions, to get a decent yield past inflation, they leverage them the same way you do a piece of property. So they borrow against them, they pledge them as collateral. So a bond is one person or one institution's IOU, but when you are the person who owns it, they owe you. And so it's your asset, has counterparty risk, because if the bond issuer fails to perform and goes bankrupt, you got nothing. But even if you have something, if interest rates change, it could go down. So what you do is you borrow against it and pledge it as collateral, and you borrow even more money, and then you buy more bonds. And so you take the same amount of initial investment, and through this hypothecation, this leveraging, you are able to get more yield on that same capital because you're borrowing. The problem is in that game in the financial casinos of Wall Street is if the bond price falls, you get something called a margin call. Anybody who's ever traded stocks on margin knows what that's about and knows how unpleasant it is when you get the margin call, because your choices are come up with cash that you may not have, or sell the asset, sell the bad asset at a bad price, or sell your only good assets. It's just not good. There's no way it's good, right? Nobody likes to get those calls. Well, that's what happened in 2008. The subprime mortgages started going bad, and the mortgage-backed securities they were all indexed to started to underperform. And when they did, bond prices started to fall. But because of the hypothecation, the derivatives, it just spread like wildfire across the financial system. And then once everybody had to sell and nobody was buying, you have a market in free fall. And the Fed literally had to print money out of thin air, taking their balance sheet from 800 billion to 4.5 trillion, and step in and buy all those toxic assets to put a bottom in so the market could stabilize. And so you don't understand any of that if you don't understand the basic concept that bond values are inversely correlated to interest rates. Now, understanding that, if you realize that the world is full, trillions and trillions and trillions of dollars of bonds and derivatives, if interest rates were to go up, it would be an absolute train wreck. But where are interest rates now? At zero.
Down.
So you think, well, the only way they could go is up. They certainly can't go down, but they can, because you've heard talk about negative interest rates. But how do interest rates move? Somebody has to step in and buy bonds and bid up the price of the bond so that the effective yield goes down, right? Just like I talked about, if you buy a $50,000 bond that's throwing off $5,000, right? That's a 10% yield. If you wanted to drop interest rates to 5%, you'd have to bid 100,000 to get that, to drive it down to 5%. If you wanted to drive it down to 2.5, you'd have to bid 200,000. So that's a lot of cash that has to come into the system to purchase those bonds and bid them up. But if nobody's buying, who wants to buy a negative yield bond? Well, nobody. So who's going to buy them? The central banks. How do the central banks buy them? They print money out of thin air. When you print money out of thin air, what does that do to the value of the currency? It dilutes it. That's called inflation. And they say there is no inflation, but anybody living in the street tells you there is, right? Housing prices are going up, healthcare costs are going up, food prices are going up. And the wages aren't going up because it gets offshored and in technology as businesses fight to survive. So it's a double whammy. Prices going up, wages not going up. It's an ugly scenario, and it's all created because of a faulty system that's based on unsustainable debt. And we're in the end game. This thing has to reset. It has to, just like it did in 71, just like it did in 44, it has to reset. So we're living in very interesting times. I don't know what the reset's going to look like, but it has to happen.
Yeah, and so there, the reset is going to happen. I guess these things are cyclical, right? And so I guess a couple of things. I have two questions, but one I need to get out because I think it was a couple of weeks ago I was watching Jerome Powell, who was giving his Jackson Hole speech and talking about what was going to happen, and he made a really interesting statement. He talked about the average rate of inflation moving forward, so a forward-looking view at 2%, and so I'm just curious. What does that actually mean for someone who is looking at protecting their wealth with some of the things we're talking about now?
Well, at the end of the day, you need to be hedged, right? I just did a newsletter, I think, that got released yesterday as we're recording, and just talked about how certain financial managers are suggesting tips. Inflation protected Treasury inflation protected securities, and the idea is that you're not, if there's inflation, then the yield on the bond adjusts to protect you so that you remain positive yield. Of course, it's indexed to the CPI, and the CPI is a manipulated index. If you visit something like shadowstats.com or you look deeply into the CPI, you'll realize that they changed it from what it was prior to the early 80s to hide the fact that we have this kind of inflation. But the Fed is trying to, when they talk about inflation, they're talking about the CPI. They're not talking about Wall Street asset price inflation. They're not talking about housing inflation. They're not talking about a lot of the things they purposely hyperinflate. they're trying to preserve the asset value of things that banks have loaned against. They're trying to push it into the wage side of things, but they can't do it because companies aren't able to stay profitable. They've continued to find ways to innovate to bring costs down, and one of the biggest costs in industry is labor. So to hedge yourself against that, you need things that are going to respond positively to falling currency values, and that's why you see people moving into stocks, moving away from bonds, and the only reason bonds continue to have a market is because central banks are buying them. Gold caught a bid for that exact same reason. I think real estate will catch a bid, but you have to be careful about the kind of real estate you buy, because real estate, much investment real estate, is based on business profits and paychecks, and those things are tougher. So this is where you have to be strategic as a real estate investor, and I talk a lot about the importance of picking markets, price points, demographics, product types, and even neighborhoods that have a fair degree of people above them, so that meaning living in more expensive places, so that as the economy squeezes them, as they move to try to find a safe place to be where they can still have a decent quality of life, they'll move to these areas. Again, yesterday's newsletter talked about Stripe, the little credit card processing company. And they just came out and they said that they're offering a $20,000 bonus to anybody in their Seattle, New York, or San Francisco offices that will move to a less expensive city and take a 10% pay cut. Now, the people look at that and go, I can get $20,000 up front. I can move to a much less expensive, lower tax area. And even though I take a 10% pay cut, my net lifestyle went up. See, I've been talking about that. I said, people are going to figure this out, and that's what they're going to do. And COVID-19, the great accelerator, has just convinced companies that they actually can manage and work effectively with a remote workforce. So this has opened up real estate markets that weren't previously available. Between the technology and the new attitude towards remote workforces, I think you're going to see more of that happening as companies continue and people continue to try to find a way to get by on less without taking a reduction in lifestyle.
Yeah, so
any of those things are going to respond favorably in this type of an environment, comparatively speaking.
Okay, so it's definitely going to be, comparatively speaking, better. And I guess one thought that I just had in my mind is, what is actually going to happen to the influx of people in Puerto Rico, I guess, based on what you're using that example, right, where you can have a lower tax area and also if it was only a 10% reduction, maybe one of the territories would be available as well. Why not?
Well, I think you have to argue the quality of life. People are,
fair point.
Right? So, for example, Phoenix is the recipient of people fleeing Southern California, right? Salt Lake City, Boise has been booming. Why? Because people who can't handle the heat, who want to go to a nice community that is within spitting distance of the West Coast, are going to end up in Boise. I know, because I was in California and I started looking around and I said, well, where do I want to go? I moved for a little while to Las Vegas because I like the warmth, but Las Vegas is, it's Las Vegas. So it's kind of a mono market. It's small. It doesn't quite have the quality of life, but you come to Phoenix and you got major medical, you got major sports teams, you've got all kinds of stuff. You're not that far away from the water. A lot of Southern Californians like that. You got a more business friendly environment, a lower state income tax. Everybody has a lower state income tax in California. But that's my point, is there's going to be places that have all the great infrastructure. Puerto Rico, people who travel a lot, our friends, Simon Black moved his business down there. Peter Schiff moved there because they make tons of money and the tax savings was well worth it. And they travel so much that the fact they don't feel like they're trapped in Puerto Rico and limited to the lifestyle of Puerto Rico. They're more global people, but people who actually live in a neighborhood and really live in a community, they may not be willing to do a Puerto Rico, but they might be willing to do, a Boise, Idaho, or a suburb of Phoenix, or maybe something in the Midwest. A lot of Indianapolis has been the recipient of people from Illinois and especially Chicago. So those are the type of migration patterns real estate investors look at.
Okay. And Russ, when you're talking about migration patterns, right, and you're talking about looking at those things, what are some of the ways that someone who is looking to actively or passively invest, they can find out, like, how are people moving from one place to the other in the U.S. It may be something that they're interested in now because they're listening to this conversation and they just don't know where to start to look for those types of migration patterns. Wasn't that amazing? Now, make sure that you make it back for the second part of this conversation so that you can absolutely find out how to figure out these different migration patterns. Trust me, anyone that's looking to invest passively or actively, this is one of the key indicators that's going to help you moving forward. But aside from that, when you make it to the next conversation, you're going to get the chance to really learn even more. You're going to find out not only about these migration patterns, especially a lot of you very busy professionals. Russell's going to get into some of the things that you should be thinking about as you look to build out your own personal philosophy as it relates to investing. You're going to find out more about what you can do to compress timeframes, and also get some insight into the real asset portfolio theory, which is something that's really affected me, helped me positively in the way that I go forward and bring a lot of the value to you as one of our members. He's going to talk to us about, an interview that he had with Ivana Trump. And it's going to be pretty interesting because he and I have that in common as well. You'll find out why when he talks a little bit more. When you hear that part of the conversation, you're going to get his book recommendations and also some tips for what you can be doing to move forward faster. So also, as you always know, best way to get in touch with me, go ahead and reach out. You can also go to billykeels.com/7 mistakes to avoid. And we're going to look forward to seeing you back on the next part of the conversation. Make it a great day. Wow, don't you love hearing from top-notch experts in the field? You know, when I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long-distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.